While recent inflation data show that consumer and wholesale prices are still rising way too fast, a major change at the Federal Reserve means that real relief could finally be on the horizon. Hi, I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. Let's talk market forces. These are the four market forces I want to highlight today. Inflation moves higher, but hope has arrived. The U.S. declares victory and looks to escape another failed war in the Middle East. KPMG published an AI report that's full of AI hallucinations. Capital-light tech giants are transforming into capital-intensive hardware companies. And some side notes. The AI reality check is here, and the stock market is showing signs of structural instability. Before I jump in, as a reminder, this video is for educational purposes only and does not include any recommendations. Your portfolio should be customized to your personal investment expectations and risk tolerance. If you're interested in receiving personal investment advice or would like a free professional portfolio analysis, contact me directly. Now let's get to the market forces. Inflation moves higher, but hope has arrived. Inflation is a tax. You can never regain the purchasing power you lose to inflation. Despite what you hear from politicians and the media, rising prices are bad for your personal balance sheet. Prices never fall. They're always rising because the government and the banks are constantly increasing the money supply through financial operations and fractional reserve banking. Investors who own stocks and real estate prefer low interest rates because borrowing money is cheaper at low debt costs, and that boosts spending, investment, and growth. The cost is inflation, a devaluing of the dollar, and a tax on savers. On June 10th, the Bureau of Labor Statistics reported that consumer inflation, that's CPI, rose to 4.2% over the last 12 months. CPI has been running above the Fed's supposed 2% target for over 5 years. And now, at 4.2%, the trend doesn't look good. On Thursday, another report showed that wholesale prices, measured by the Producer Price Index, that's PPI, rose 6.5% over the last 12 months, the highest since 2022. Because PPI measures costs before they reach consumers, higher costs will soon be passed on to consumers. In January, after President Trump announced that Kevin Warsh would be his pick to replace then Fed Chair Jerome Powell, I published an article called "Will the Fed Finally Be Reformed?" After Wednesday's press conference, there's hope that years of bad Fed policy will finally be coming to an end. The new Fed Chairman, Kevin Warsh, gave a tough talk in inflation, saying, "Persistently high prices are a burden on the American people, but the recent past need not be prologue. I'm pleased to report that the members of the Federal Open Market Committee are unambiguous and unanimous. This committee will deliver price stability." Warsh's tone stands in stark contrast to the policies and the words of former Fed chairs, including Jerome Powell, who said last year, quote, "We don't comment on the dollar. Really, the administration, and especially the Treasury Department, has the job of oversight of the currency. It's not our role, so I have nothing for you." Many on Wall Street were expecting Warsh to be another dove, with a bias towards keeping interest rates low, but they were not paying attention to Warsh's comments leading up to his appointment. In May of last year, Warsh sat down with Peter Robinson of Uncommon Knowledge and described the post-2008 era as the complacency era, where the Fed became addicted to crisis tools like quantitative easing, and he called the 2021 transitory narrative the greatest mistake in macroeconomic policy in 45 years. He said the elevated inflation we were seeing was an echo of the great inflation of the 1970s. Pandemic stimulus, QE to infinity, and institutional drift led the Fed to ignore the money supply, which is the true driver of inflation, and that's widened the wealth gap and driven the affordability crisis. Thankfully, it looks like the new chairman is going to work to reduce inflation and shrink the balance sheet and restore public trust in the institution and the dollar. In the words of the Wall Street Journal editorial board, Mr. Warsh presents an extraordinary opportunity to reform the Fed so it resumes its role as a steward of price stability to underpin stable growth and rising incomes. The U.S. declares victory and looks to escape another failed war in the Middle East. On Wednesday, the official text of a memorandum of understanding was reached with Iran and released, and most U.S. media outlets chose to report on what the administration was saying about the deal rather than what the deal actually says. The interim deal reads like a surrender document because Iran has the upper hand, and it was the only way that the U.S. could get Iran to the negotiating table. The good news is that the violence will likely decrease and maritime traffic will likely increase, at least temporarily, and it buys time to allow the two sides to attempt to hammer out the details. It does not resolve the core issues surrounding the ongoing mechanics of the Strait of Hormuz or any Iranian nuclear concessions beyond what was already in place before the war. Those issues will be addressed, but not likely resolved in a second phase. There are structural incentives in the United States, in Iran, and Israel that will make a second phase difficult to achieve. To date, the U.S. hasn't shown the patience necessary to complete a complicated nuclear deal that requires new monitoring and verification measures. Iranian Supreme Leader Mojtaba Khamenei may not want to do anything beyond a small transactional deal given Trump's withdrawal from the JCPOA and the Obama administration's 2018 deal and the fact that the U.S. and Israel killed his father, his mother, his wife, and his son. It's possible Iran agrees to terms that are wildly in its own favor, but those are likely to be so unpalatable in the U.S. and in Israel that a long-term deal seems unlikely. Meanwhile, Israel appears to be opposed to any deal and will use its influence to block or undermine one. As details about the parameters for future negotiation emerge, they'll be spun by Washington and the media. I expect the final negotiations to be settled largely in the favor of Iran, with U.S. officials claiming overwhelming success as Americans grow tired of the story and shift their focus to the next shiny object. KPMG published an AI report full of AI hallucinations. Consulting firms like KPMG publish industry reports as a strategic marketing tool, positioning them as thought leaders to gain media exposure, build trust, and gain new clients. The stakes are high among the big four accounting firms to produce and to win high-paying advisory clients. KPMG is smaller than its competitors Deloitte, PricewaterhouseCoopers, and Ernst & Young, but it's still a massive multinational company employing over 275,000 people across 143 countries and territories and generates over $14 billion in annual revenue. Last fall, they published a white paper called Total Experience: Redefining Excellence in the Age of Agentic AI, which explained how companies are using AI to cater to customers' needs. Apparently, though, the report was full of AI hallucinations and it included examples of agentic AIs that either didn't exist or didn't have the capabilities that KPMG stated in the paper. Investigators for GPT-0, the maker of an AI content detection tool, found that inaccuracies and fake footnotes were all over the report. They were also verified by the Financial Times. In its report of the investigation, GPT-0 said that only 5 citations of the 45 in the paper actually pointed to real sources, and about half of the claims in the paper were fake or misattributed. KPMG claimed that Emirates Airlines has an AI agent that can change passenger bookings, but they actually don't. They also claimed that UBS integrated agentic AI across advisory and risk management, compliance, and compliance monitoring. but the bank told the Financial Times that's factually incorrect. There were several other equally egregious lies published in the report. Papers by companies like KPMG are heavily relied on by other publishers because they're highly trusted sources. And so error-riddled papers like this effectively poisons the well of information. And since AI is being trained on information like KPMG reports, this kind of lazy work can lead to unreliable reporting from other publishers and second-order AI hallucinations. What a mess. KPMG pulled the report and said they're reviewing the circumstances surrounding its publication. Capital-light tech giants are transforming into capital-intensive hardware companies. Google announced that it'll be raising $85 billion in new capital through an equity sale. Historically, software has not been a capital-intensive business. The last time Google raised capital by selling equity was when it went public in 2004. So why is it doing so now? Well, because they're a committed AI hyperscaler and the stakes are going up. They can't turn back now. In 2025, Google spent $80 billion on AI CapEx, which was funded from its enormous cash flows. This year, Google will spend over $180 billion, and they just don't have that kind of cash. Meta and Microsoft are expected to raise more capital too for their CapEx spend. These traditionally capital-light software companies are transforming into capital-intensive hardware firms, and in my view, investors are growing skeptical. The insatiable need for capital to fuel the AI race is starting to become a burden, and recent volatility and relative underperformance of the Mag 7 stocks may be evidence that investors are starting to realize it. And now for some side notes. This week, the side notes are focused on AI because there's a very real sense in the market that AI, tech stocks, and the broader market are facing a reality check. The question is the recent uptick in volatility a sign that the AI trade is losing steam? A number of stories has emerged over the past 2 weeks suggesting that may be the case. Scott Melker of the Wolf Den pointed out that the biggest IPO in history, SpaceX, is trading like a meme stock. Seeking Alpha broke news that Microsoft may replace OpenAI and Anthropic models with its cheaper competitor DeepSeek in its Copilot product. And leaked audited financials show that OpenAI lost a massive $38.5 billion last year. And Wall Street insider Doug Cass explained why he believes the stock market is now showing signs of structural instability. For links to all these stories and everything I've covered today, subscribe to my weekly Market Forces newsletter at alpharockinvestments.com. While you're there, get your free download of my quarterly investment outlook, which explains how I'm investing for my clients. Before you go, like this video and subscribe to my channel. It helps me reach new viewers. And if you have a question or you'd like a free portfolio analysis, contact me directly. Links are in the description.